The ProACT Know-How.
Hi, this is ProACT Sam. Welcome to this webinar. Nod if you can hear me, or give me some other sort of sign. We're trying to snag our way through this logistics. Welcome to this live webinar with all its faux pas. And what we're looking at today, thank you, Amanda. What we're looking at today is capital gains tax liability across border for expats. And all that contains. Now, ProACT have got offices in the UK and Cyprus, but we help expat clients around the world. And tax is our thing, and tax residency is our thing. Just a couple of updates. You know, things are changing all the time. Things are being amended. And it does lead to frustrations. So, for example, you know, at the end of May 2021, we still can't do 2020 tax returns for Cyprus. They were due out at the end of January, then the end of March, and like last year, they're getting deferred and deferred. We can do UK tax returns now and for other countries, but you know, it is a big issue. Another thing that expats should be watching at the moment is tax residence. So we're getting towards the end of 3 months into the current tax year. So if you're an expat that's locked down in the UK, it's beginning to potentially have an impact on your tax status for 21-22. So that needs to give some thought. If you want to talk to us more about that, contact us at ProACTpartnership.com. For retained clients, you can chat to us on our retained client chat app, which is available through our website at ProACTpartnership.com or ProACTpartnership.co.uk. Essentially, if you want to claim exceptional circumstances for COVID to say that you're locked down in a particular country, that's only valid if the official government rules say that you can't travel for business or personal reasons. And that's a bit of an issue at the moment for people, and we need to be aware of that. So in mid-April and mid-May, relaxations have begun to be unwound. So nobody in England was allowed to leave the UK before the 17th of May. Now you can, if you've got a justified business or personal reason. So this is something to look at for expats that are locked down in any country around the world. Where are you up to? Whether you're coming up to the half-year point or the first quarter point, how's that going to impact on your tax residency, tax status for next year? Contact us at ProACTpartnership.com for more information. The main meat of today's webinar is about capital gains tax, and to try and put that in perspective for expats. And we're going to look at three examples of how we can manage that. It all comes down to your tax residence. Exchange of information brings more and more regulation and burden on individuals to confirm where they got the money from and where the money is moving to. So every individual has his tax residence. So an expat that lives and works in Portugal or France or Germany becomes a tax resident in that country. That is their tax residence, and it's their home country. So they're taxed for everything in that jurisdiction. A company could be based in a different location. So in the UK, Regus have service offices all around the UK, but it's a Luxembourg-based company. So they have a different tax residence for the company as opposed to individual businesses or employees within the UK. And that brings cross-border tax planning into play. But not just companies can do that, but also if you use a family trust or business trust or foundation, then you're able to move your assets and have a separate tax jurisdiction. And the separate tax jurisdiction can give you tax planning opportunities to maximize your liabilities. I'm not going to cover around the world. We give specific advice to people from Singapore, Malaysia, China, people in China, Australia, UK, and around Europe, as well as countries working in Africa or living in North America. So we can do that. But generally for these events, we look around 2 or 3 locations. So I'm just considering the perspective of UK capital gains tax liabilities and comparing that with Cyprus and Portugal for this event. So if you're understanding this point, that at the moment now, for this part of the talk, we're talking about people that are tax resident and living in that country. So your whole tax assessment is for that one country. So in the UK, capital gains tax ostensibly is 10%, and you get a personal allowance each year of 11,000. So you can make a gain of 11,000 and not paying a capital gains tax. So entrepreneur relief when you sell businesses at a later date and other incentives. But generally, it's only 10% if you're a basic rate taxpayer. So once your tax goes above 50% and your high rate tax £50,000 and your high rate taxpayer in the UK, your capital gains tax is 20%. And in the UK, capital gains is assessed on a flat rate basis. So what you paid for and what you sell it, that is the gain. There's no indexation that takes place. But over the last few years, over the last 5 years, culminating in April last year, there's been a lot of work that's been done to tighten up the rules. And now there are separate capital gains taxes on UK property, especially UK residential property. So UK residential property is singled out for different capital gains tax rates up to 28%. So an expat who's got a high rate tax income in the UK could pay 28% on a capital gains tax on a property that's sold in the UK. A lot of people in the UK benefit from capital gains exemption on their main residence. But once you become non-resident, it can't be your main residence. And if you argue that it is, then you tie yourself up for other assessments and other tax liabilities in other areas. Inheritance tax, for example, in the UK is another form of capital gains tax. So a lifetime gift can attract an inheritance tax, a capital gains tax of 20% when gifted away, even to family members. And that can be 40% on death. So there are ways to catch you in. So with the main residence, if the expat goes abroad and starts renting that property, then they can get main residence relief for the period up until they leave, potentially important to provide the evidence to the taxman, but then gradually it falls under capital gains tax relief. So a later sale will suffer capital gains tax. Now you compare that to a country like Cyprus, and it's a different system. There's a 20% capital gains tax, and it's index linked against the official inflation rates in Cyprus. So if you've made a gain on your investments or your company shares, then you've got a potential index linked capital gains tax. And that also applies to all property. There is no family relief for property in Cyprus. So if you buy a property for 100,000 and sell it for 200 after indexing and allowances, then you have this a 20% tax, as 20,000 capital gains tax you pay. In Cyprus, there's a one-time £85,000 capital gains tax relief, but that's once in a lifetime. So if you're buying a second or third property, that won't allow, but it doesn't have to be. It doesn't have to be your main property or gift to family to use that 85,000 exemption. I'm coming back to Amanda's point in a moment. In Cyprus specifically, then any property sale attracts a 20% capital gains tax, index linked, as does a share sale in Cyprus. If that property is not in Cyprus, then capital gains tax, it doesn't come from Cyprus. So we're going to look at capital gains tax from the perspective that it's tied to where the tax residence is. So just to finish off on the Cyprus side, in Cyprus, any gift to family is free of inheritance tax, but it's also free of capital gains tax. So a gift of property in Cyprus to a blood relative or a married partner is free of inheritance tax or capital gains tax. And that's for anybody for any amount. So if you own £1 million property in Cyprus and sell it with a gain, you pay the capital gains tax. If you own £1 million property in Cyprus and give it to family during your lifetime or on death, there is no capital gains tax. So it's a perfect vehicle for giving away tax on that property. Now, where the property is relevant. So we talked earlier about capital gains tax, tax residence. So an individual can be resident in one country, a company can be resident in another country, and the employee can be in one country and the company taxed in another. And it's the same for capital gains. Capital gains are charged on fixed assets. There's two types of assets in this world. In law, there's movable assets and there's fixed assets, or called real estate is another term for a fixed asset, or immovable property is another term for a fixed asset. It's in the country. So generally, if you look at a bank account, it holds your cash goes with you. So even if it remains in Portugal or France or the UK, it still lives with you in your tax residence, be that Germany or UAE. However, if you've got an investment holding, shares or property, whether those shares are held in a fund or whether they're held as direct business share ownership, they are deemed to be fixed where those assets are. So if you've got shares in the London stock market, there's a potential capital gain in the UK. If you've got shares in a Cyprus stock market or Cyprus business, then the tax is liable there. If you've got business in a Portuguese company, the capital gains liability on the disposal would be liable in Portugal. So then it comes down to the double taxation treaty. So in Portugal, for overseas capital gains, the Portuguese would charge 50% of the overseas gain to capital gains tax. In the UK, they will charge you a capital gains if you're a tax resident in the UK on your worldwide capital gains. If you're an expat and you're not in the UK, the UK expat with UK investments will only pay capital gains on the UK assets that are sold. In Cyprus, very, very simple, they don't charge capital gains for overseas capital assets. So a UK expat selling a property in the UK is liable to UK capital gains, but not Cyprus capital gains, because and that is just not assessed in Cyprus. For investments, Cyprus do not apply capital gains tax on investments. Now they do on shareholdings, but not on investments. So if you've got an investment in the right type of holding, you can pay no capital gains tax on any profits that you get. And that, my friend, includes Bitcoin. So if you made $1 million on Bitcoin over the last 3 years, if you're a UK tax resident, you sell that, you have it as a tax resident in the UK, you have a tax liability in the UK. If you're dealing through a trading fund in the UK, you potentially have a capital gains tax liability in the UK. It's an international a trading platform. That trading platform reports the capital gain to their local authority, maybe the States or maybe China, and that gets exchanged back to your country of tax residence. So if that was Cyprus, your capital gains would be nil. If it's the UK, your capital gains would be up to 20%. If it's Portugal, the capital gains tax potentially 25, 28% of half of that profit. Okay, so that's really, really complicated. I can't believe how complicated I made that. Going back to Cyprus, there's no inheritance tax either. So I'm bringing in this idea of flat rate taxes as well. So, you know, for the high net worth schemes for Portuguese tax residents, it's a flat rate tax system. So when they tax your income at a flat rate of 20% or 10%, that's on all your income. You've got no allowances or no compensations or no offsets. You've got no ways to move around that. So it becomes quite complicated. And it's a case-by-case basis. So the individual country where the asset is based is where the capital gains tax liability will arise. So how can we manage that situation, and how can we work to ensure that your family's and business wealth passes to your family and not to the taxman? With the UK, there's a very good exemption for expats. If a UK tax resident relocates abroad, becomes non-resident to the UK and tax resident in another jurisdiction, before they make the decision to sell the financial investment like Bitcoin or shares, or their share in a business, you know, why would Dyson move to Singapore before selling out his UK business? You know, because that becoming a non-resident from the UK and then going through a process of selling, disposing of commercial property or investments or business means that capital gain for that business or that commercial property in the UK is still taxable in the UK under capital gains tax rules. However, for a non-resident, that the tax liability is deferred for 5 years. So if the UK expat, the UK tax resident expat, stays out of the UK for 5 years, that capital gains liability up to 20% falls and isn't applied during their lifetime. However, with the new changes of residential property legislation, that doesn't apply for property in the UK. Doesn't apply for property in the UK. So UK residential property is potentially liable up to 28% capital gains tax. That tax return has to be done within 30 days of selling the property, with any tax paid at that time, and then a return at the end of the tax year to confirm that capital gain. So with the UK, a business commercial property sale, capital gains tax free, but as long as you're non-resident before the sale goes through. But with residential property, you can't avoid the tax if you sell it. You can, with the UK, avoid a capital gains tax, and that's by giving it away. So in the UK, there is inheritance tax of 40%, but there's an allowance over £300,000 that you can give to a family member during your lifetime without inheritance tax, without a lifetime inheritance tax of 20%, i.e. capital gain, or on death. So there's so much you can do for that. So a UK property can be gifted to family members and protect it from inheritance tax. If you create a holding company, again, this is subject to different rules. When you buy property, you may have stamp duties and purchase tax costs. and they can be quite expensive. And even if you're doing a transaction to change the ownership to an offshore company or an offshore trust, those taxes can still apply, and so that can be that is a cost of taking such a transaction. However, if the overseas entity can hold that asset, then potentially there's ways it can start to mitigate the tax liability. Essentially, if there's a capital gains tax liability in the country where the property is, and when it's sold, it's going to have that capital gains liability every time, unless you organise it that asset is owned by somebody else or is gifted under rules that allow it to be gifted without tax. So in Cyprus, there is an international trust that anyone who isn't a Cyprus tax resident can hold assets in there and pay 0% tax in Cyprus. So you can hold property, you can hold business, and you can hold investments in that international trust and pay 0% tax in Cyprus forever. So as long as the arrangement is such that, for example, you've got family beneficiaries, so it's a gift and not a sale, then you're potentially giving away or having a tax-exempt transfer, and that's free of the transfer taxes as well, potentially, of the asset for it to go into trust. And therefore, you then create, many of you will have pension funds from your work or your savings during your lifetime. That's a pension trust fund. It has administrators that look after that trust and pay you a prescribed income under prescribed tax rules when you reach a certain age. Cyprus International Trust is like having your own family trust fund for your family's benefit at some point. So there are rules that vary on case-to-case basis, but for holding property in Cyprus or the UK that then becomes exempt from UK inheritance tax or Cyprus or UK capital gains tax, it's a perfect entity. But it works for businesses around the world as well. So if a Cyprus trust holds a business that is then operating in Singapore or in Africa, the local transactions might still be subject to sales taxes and to employee taxes, and maybe even local corporation or income taxes for the individual tax resident for part of the income in that jurisdiction. But so we can't evade tax. We're not trying to do it. What we're trying to do is minimize the tax liability, because any dividend paid from any business or any investment is always the tax liability of the recipient. If the recipient is an international trust in Cyprus and it receives dividends or income from around the world, then that becomes inheritance tax-free. It becomes dividend tax-free, becomes corporation tax-free. It's a 0% tax on that Cyprus trust fund. So it's a way to avoid gains by gifting. It's a way to avoid gains by receiving income from retained profits within the company. So it doesn't necessarily mean that your business in your locality is not paying all the right amount of municipal, regional, or capital taxes, but it allows you to minimize that tax and manage it with the added advantage that when you're using a trust or a company arrangement on an international basis, you also avoid the cost and delay of probate, because a trust will carry on. It doesn't necessarily apply to I've just been reading a question. Thanks for that question, Tony. I'll come back to you in a minute. So the trust is a tax resident. This is to answer Tony's question. The trust is a tax resident in Cyprus. So if the trust is a tax resident in Cyprus, it has no taxes in Cyprus. So if it's owning a business or property anywhere else around the world, Singapore, UK, Portugal, there's whatever income it receives, whatever movable income it receives, doesn't get taxed in Cyprus. The profit that it makes in Cyprus doesn't get taxed. The capital gains tax doesn't get passed. The inheritance passed to next of kin or gifted to family doesn't get taxed. It's a zero tax for everything. It's not that it doesn't get taxed. It does get taxed. Not like the Middle East where there's no tax. There is a tax assessment, and the tax assessment is zero for the Cyprus trust. So if you own a Portuguese property within the trust is the owner. So when the property is disposed of, the local taxes for disposing of that property could well be subject to local Portuguese taxes. If you're renting that property in Portugal, the rental income generated in Portugal would have a local tax liability potentially. But the actual ownership of that property and the receipt of that income and dividends from a company receiving that income would all be free in Cyprus. So it's complex on a case-by-case basis. It doesn't work for everybody. And there are reliefs within Portugal that allow people to reinvest income to avoid taxes, as there are in the UK and as there are in other countries as well. So on a case-by-case basis, we need to look at that. So having a holding company or an employee benefit trust allows you to have a separate tax entity for your assets and your income, which can then be taxed in a different regime. So that could be a flat rate regime for Bulgaria or Portugal. So Bulgaria will charge you a flat rate of 15%, Portugal 20%, but that's on all your income. Other countries you can have 0% tax, but maybe have some smaller tax liability elsewhere. It's about organising your family's wealth and your business wealth in a way that suits you. So we love this area. It's really interesting. It's what we're very, very good at. And if you want any help, you have to go to ProACTPartnership.com and contact us or jump on our chat line and talk to us more about how we can help your situation. Our consultants will give you a free review, talk it through, see if there's anything that you could do. And if there is, that's great. And if we can help you some more, we'll do that. Now, another way for business is, and it's a bit of a dirty word because this year in the UK, IR35 has been introduced. So expats that are living and working abroad, especially close to the UK or even further afield, but they've got contracts with UK companies. Those contracts could fall under IR35 rules. Now, this is essentially a big company tax. So it's big companies that are trying to avoid local taxes will apply. So smaller businesses can avoid this. But even so, if the expat is doing contracts with lots of different people, again, they can avoid those taxes to a greater or lesser degree. So it's important to consider what your situation is with regard to the UK. If you're contracting with the UK, there's lots of different rules for different people. You can have contracts with a UK company, but post-Brexit, some contractors have to be done with an EU country. So people are now contracting with a different company in Europe, and that in itself can get in the way from IR35. You might need to do a self-assessment statement of that, and that's another way forward. So again, IR35 issues, if you've got any of those, come to us, contact us at ProACTPartnership.com, and we can talk them through you and see if you've got a problem. However, what we said earlier is that if you're an individual and you're a sole trader, your business and your personal tax and your property tax are all under one regime. Okay, every property has its own tax number, every company has its own tax number and tax liability. And it can split those up. So as soon as you become an expat and a tax resident in another country, you've got an option to consider how it can work differently for you. So again, we mentioned that with Cyprus, that there's potential to organise your business in such a way that you're paying 0% tax, or it might be a flat rate tax regime that you would operate under in Bulgaria or Portugal. And a UK company, if you're operating through a UK company, the attraction there is that sales tax doesn't apply until your turnover is in excess of £85,000. So that's a big attraction there for operating a small, simple personal service company. And for expats, what that does is allow you to split up where you are personally tax resident and where you're going to pay your tax. So if your personal service company has got a tax rate of 12.5%, for example, with Cyprus or Ireland, then that might be preferable to paying a 40%, 45% tax rate in Germany. Now, you might not get away with it in Germany, but it's to illustrate the point, is that if your company is in a low tax regime, like Bulgaria, 15%, Cyprus 12.5%, Portugal 20%. If your company is based in that location, you can then live elsewhere and manage your income so that you receive an income that's tax efficient in your locality. So if the personal allowance in your country of tax residence is £20,000, but you don't get taxed on dividend income, then your company can pay you dividend income without tax and the personal income without tax. There are other ways to do that as well, but the personal service company also covers your expenses. So for an expat that is tax resident in Spain and wants to travel to Norway, that travel expense is from the company. So you don't need that income. You don't need £1 million income unless you're going to spend it. So if you leave that £1 million income in the company and take out your 50,000 spending money, I didn't see all your note, Tony, and I'm not that sophisticated. Next month, I will have a production assistant that will help me gather this information in. But I haven't got a screen still that tells me, so I can see all the question there. Tony's point is that in the different countries like Portugal, that there are different regimes and different ways of operating and different rules that you need to plan to avoid. The point I'm trying to make with the personal service company is if you're a contractor and you're working around the world, you can choose your tax resident, and your tax resident could be a high tax residency, but because your company is operating out of Isle of Man or Bulgaria or Luxembourg or Cyprus or Jersey, then the company has the local tax regime of that jurisdiction. Now, exchange of information, make sure everything has to be done. But if you operate a company correctly and make the returns on time and keep everything appropriate, and you're genuinely running a business, then you can do that. And that would also avoid IR35 if you're contracting with UK businesses. IR35 doesn't apply to small businesses with turnovers under 10 million. It applies to bigger businesses only. So for a lot of smaller contractors, you can still stay clear of that IR35 rule, which subjects any income from around the world to pay as you earn rules in the UK. But what you do is look at how you could set up a local public service company in the most tax efficient way. And it might be in the country in which you live, but it might give you the freedom to travel around or move around or live in a place that suits the family. So that's the issue there. So those are our thoughts on capital gains. To sum it up, thank you for listening. Where your tax resident counts, whether you're a property, a company, an investment fund, a Bitcoin holding, or an individual, or a trust fund, or a holding company, you have a tax number. And that tax number ties you to where that tax is paid. There's two types of assets to pay tax on. There's movable, like cash, and earnings, which will move around with you and be taxed where you are tax resident. And then there's fixed assets or capital assets, which are subject maybe to income taxes, but usually to a capital gains tax. And that is a different liability. And the real estate, the fixed assets, the property, the residential property in the UK, they could well be taxed in the jurisdiction in which they're in. So how to avoid that is to manage that. Can you have a holding through a family trust or a holding company? Will that help mitigate that tax liability? Or will you need to consider something else like gifting to avoid the ultimate and final capital gains tax, which is an inheritance tax on death? So there's lots of ways to gift to family where you can pay from 0% tax. And under any double taxation treaty, it's covered. Some double tax treaties don't cover capital gains, therefore it's not assessed. Therefore, you can live in a country without a capital gains assessment or a zero assessment. Other countries will want the full double taxation pound of flesh, so that you pay in the country where the gain is and any extra in the country where you're tax resident. So at ProACT, we know how to help you manage that process and to get your circumstance suited to yourself and suited to your family's circumstance, with the ultimate objective that your wealth, your business, your property passes to your family and not to the taxman. We are supposed to do, that's the finish, and we're supposed to do extra questions for retained clients. So some of you might find yourself getting kicked off at the moment.
The ProACT Know-How, brought to you by ProACT.